So good morning, everyone, and welcome to Montaka's Q&A webinar, and thank you for joining. My name is Giles Goodwill, account manager here at Montaka, and I'm joined by Chris Demasi, founder and portfolio manager. Thank you for joining us, Chris.
Thank you for having me.
Not a problem. So I've spent the last 2 years traveling around Australia, getting to know a lot of our investors and hearing firsthand questions on markets, the portfolio and performance. So I thought it would be a good idea today to invite Chris in for an informal discussion so you can hear and answer questions that you have posed to me over the last couple of months. So I'm going to run this as a bit of a Q&A format, and I've got a list of questions I've compiled from seeing you, as well as ones you have submitted leading up to today. And of course, you can still post questions live via the Q&A or chat button, chat function as well. So there has been quite a high volume of questions come in, but don't worry, we don't get to cover everything with Chris today, because we'll come back to you offline in the next couple of days with answers there. So after saying that, I think it might be time to get into it.
Yeah, go for it.
Alrighty, so I'll start with the first question. So Chris, I think we can begin here by getting your thoughts on where the stock market's been and where it's going. I think last year, the S&P 500, it was down 19%.
Yeah.
But already in the first half of this year, it's up 16%. So what do you think has driven this amazing rebound?
Yeah, it's been an incredible turnaround. Last year, the market was down 20%, and I think everybody thinks about that as being solely tech-driven. They actually go back and peel the onion a little bit there. What you will find out is that every sector was down except for the energy sector. So it's pretty broad-based, even though tech bore the brunt of most of it. And then we came into this year, and it's been remarkable to see the reversal in stocks. As you mentioned, the S&P is up 16%, the Nasdaq's up 32%, and it leads you to believe that technology really has been driving the we've seen this year. That's true to an extent, but actually it's been much more focused than that. So there's been 7 stocks that have driven 80% of the gains in the S&P this year. And if I'm good enough, I can maybe remember all 7. Yeah. You can correct me if I get them wrong. I think, okay, so Apple, Amazon, Alphabet, Microsoft, Meta, Tesla, and I might miss one.
That one, was that it?
I think we'll come back on the 7th one. But those 7 drove 80 NVIDIA. Those 7, well, I should remember that one because that really knocked it out of the park. But those 7 stocks drove 80% of the gains in the market this year. The other 493 in the S&P contributed not very much at all. So it's been a market where the gains have been focused in those big cap tech winners, and especially the companies that are actually doing really, really well out of the revolution that we're seeing occur within artificial intelligence.
Yeah. Great. So do you think prices have maybe run too hard and are too high now?
That's a question that I've heard a lot. I think if you step back, where that question comes from is a really myopic almost focus on what the stock market has done or what those stocks have done in a very short period of time. And if you widen out the aperture, instead of measuring stocks over 6 months, go back and measure them at least from the beginning of 2022. And what you'll see is that many of them aren't up by much, if anything at all. And so you take that sort of group of 7 stocks that have really led the way this year. On average, they're up 63% this year. But if you go back and have a look at their performance since the beginning of 2022, they're actually down. They're actually down as a group. I think NVIDIA is still up. Microsoft might be, Apple's up. Microsoft's flat. The rest are down. So on one hand, I can understand that it's very easy to look at the recent past and feel as though these stocks have just gone too far too quickly. But over a longer period of time, if you put that in context, they've almost only gone sideways. And over that same time, a lot of these businesses have gotten better as well, don't forget. So I think if that's, to come back to it, if you're just thinking about the very recent performance, I don't think that's a very good reason to think that stocks don't have much further to run, especially some of the better ones there.
Yeah. Okay. So do you think, does that mean the market will be up or down in the second half of this year?
Oh, we'll get the crystal balls out and see. I'll give you the lottery numbers for tonight as well. More seriously though, we are not in the game of trying to forecast stock prices or stock market movements over over any short period of time. What's much more important to us is how our portfolio is going to do over a longer period of time. So while it's a very difficult pursuit to try and predict stock prices over a short period of time, it doesn't really matter to us anyway, because we own such a concentrated portfolio of opportunities that it's always going to be doing something very different to the overall broadly diversified market of 500 stocks, in some cases a lot more.
Yep. Okay, brilliant. So I guess switching gears a little bit here, how about we talk a little bit more about the portfolio? So looking at Mogul, the Montaka Global Long Only Equities Fund, this is an ASX, and the Montaka Global Long Only Fund. Both funds are up around 37% year to date to June 30, which is obviously strong numbers. Our portfolio has certainly benefited from owning about 5 of those 7 winners you just spoke about. So what do you do now? Are we selling, or are we taking profits?
We're not doing either of those things, and for very good reason. Okay, the stocks that have driven a lot of that very good performance this year are up again over the course of this year, but they haven't caught up to the great underlying business performance that's taken place over that time. And there's been some incredible developments in those businesses and a lot of growth take place over not just the 6 months, but even going back a year or two. And their share prices still have not caught back up to that sort of fundamental performance in the businesses. So we are very much staying the course here, and I don't think you should expect much different from us.
Okay, so could you give us some examples of some of those businesses improving in the last 6 to 12 months?
Yeah, look, of course, the hyperscaler cloud computing platforms, AWS, owned by Amazon, and Microsoft's Azure have done very well. But I think that one of the poster child in our portfolio has been Microsoft. The stock is still relatively flat over the last year and a half. But over that time, and in fact, even over just the course of this year, there's been some incredible developments on both sides of their business. So I like to think about their Azure cloud computing platform and their Office applications like Microsoft Word and Excel and PowerPoint, those sorts of things. So on the Azure side of the business, Microsoft expanded its partnership with OpenAI, who you'll remember is the developer of the large language model that sits under ChatGPT and powers that. And Azure is now the exclusive cloud provider for OpenAI. So anybody that's using ChatGPT or any businesses who are using the underlying model to develop new applications, they're paying Microsoft for that. They're paying Azure for that. Azure have already come out and said that their customer base, along with OpenAI, has multiplied by 10 over the last quarter. Yeah. And it's already adding to growth today. And then on the other side of the business, Microsoft announced Copilot, which is the AI assistance tools that are going to be embedded in the Office applications. And if you haven't already seen demonstrations of these, you should go online and go and search up Copilot on Microsoft's website and have a look, because you can see it do all sorts of crazy stuff, developing PowerPoint presentations itself, writing Word documents, going into your You've done this already. It's quite amazing. And what's more amazing for the company is that this now is going to allow many more users to pick up and run with those Microsoft Office applications. So the user base is already 400 million today. That's going to 1 billion and more. And the other really special thing there is that Microsoft's going to obviously be charging more for these features because they're so productive. They save us so much time and so much effort to be able to do other things. And we're already hearing that they're putting prices up by 40%, and that's pure profit for Microsoft. So, I mean, that business has just done exceptionally well. And the share price is up this year, but not over a longer period. So there's still a long way to go for that.
Yeah. And how about, I think another one, which is, I guess, quite a remarkable turnaround has been Meta.
Yeah.
How about that? How about Meta?
Yeah. Meta's right in the middle of, I think, one of the most successful turnarounds of all time. I think we've heard a lot about Meta cutting costs, which has gone a long way to helping their profitability and their bottom line. Coming into this year, we expected $100 billion in costs for the full year, and they've cut that down to close to $80 billion. But that's by the by. The real big story there is how they've harnessed the power of AI as well. And Meta's used their AI investments to be able to recommend content to users on Facebook and Instagram. That's made those platforms much more engaging. So you used to just see social content from your friends and your family, right? Now there's an AI discovery engine sitting behind there, pushing a lot more content to you. And we've seen the engagement numbers go up because of that. They've been able to use AI to improve the targeting and the measurement of ads for businesses. So advertising on the platforms has become a lot more valuable. And look, there's another big one that nobody talks about, and it's their click-to-messaging business. So while you're on Instagram or you're on Facebook or you're in Reels and you see an ad, you can click through and you'll automatically be able to start messaging through WhatsApp or Messenger with the business on the other side. And that's been a really big business in other parts of the world, not so much in the US and in Europe at the moment. But even then, it's grown to be a $10 billion business. And what they're going to do is use AI automation to create chatbots for businesses to automatically respond to people once they've engaged with an ad. So there's just so many good things going on there, all come about as a result of tens of billions of dollars that they've invested over the years in AI. And, this isn't completely being missed by the market, right? The stock price has more than doubled this year, so it's up by a lot. But again, take that measurement period back to the beginning of last year, say, when none of these developments had taken hold, before the business had started accelerating again, before profitability had started to increase and inflect again, and the stock price is lower today than what it was back then. So I think you get to have your cake and eat it too there. We've had a really nice gain in the portfolio this year because of the stock price rise, but I think there's a lot more to come.
Okay, yeah, terrific. So how about some examples outside of tech and AI?
Yeah, well, the big one that comes to mind for me is Blackstone. Blackstone's the largest alternative asset manager. So they do things like private equity and other private assets, infrastructure and that sort of thing. They manage about $1 trillion. Most of that money historically has come from the institutional markets, like big pension funds and sovereign wealth funds putting money with them to manage. But sort of in the background there over the last decade, and it's really accelerated recently, they've built out a sales team of a few hundred people, and they've become accessible on bank and broker platforms so that retail investors can now invest with them. And that's a $195 trillion opportunity. So they're doing fabulously well. The stock price is up this year, but it's still 30% cheaper than what it was last year.
Okay, fantastic. So with some portfolio changes, any changes on the horizon that we could expect in the second half of the year?
I don't think you should expect much to change at all, barring something drastic happening, or maybe we see 4 or 5 times upside in a lot of the stocks that we've been talking about. If the stock prices jump to those sorts of levels, we need to reconsider. But there's just so much promise in the portfolio today that there's a really high threshold, and we're not giving up those stocks very lightly.
Okay, yeah, very good. So I know we mentioned the crystal ball, but how do you actually expect the portfolio to perform the rest of 23?
Well, for the rest of 23, I think it's just as unpredictable as the stock market.
Yeah.
So I have no idea. But what I am extremely confident in is that the portfolio of companies that we've invested in is going to create enormous shareholder value in the coming years. And that's what's most important. And so the portfolio is up 37% this year, but that's on the way to being worth 4 or 5 times the original investment of our investors. So look, I think there's still a long way to run there.
Okay, great. I think one topic which quite a number of investors did bring to light was their concerns regarding a potential recession.
Yeah.
That is the back end of this year, second half of 2023. Is that something that is a concern to you?
I wouldn't say it's a concern to us. If you step back before we get into that, it's worth understanding how we invest and what matters to us, and what we do and don't do. And what we don't do is try to forecast or predict macroeconomic trends, especially in the short term. And the reason for that is the value that's going to be created in our portfolio is not going to be driven because of an economic cycle. It's going to be driven by the structural transformations that are happening in the world. Things like artificial intelligence and cloud computing, or the alternative asset management industry, or the rise of e-commerce or digital music streaming. These things are going to grow and develop irrespective of what happens in the broader economy. So it's much more important for us to be focused on those structural tailwinds and mega trends that are going on in the world and try and capture that value. I'd also say for people who do keep a very close watch on the economy and then try to use that to predict stock markets, that has proven to be quite a fruitless endeavor throughout history. There's very, very little link between the two, and quite often what you see is that stock markets bottom well before recessions hit and the economy bottoms, and stock markets go on and advance and lead before the economy actually turns around as well. Stock markets are very forward-looking mechanism, and so there's very little link between the two. But so far this year we've been really positively surprised with how the economy's done. I mean, if you look at the US, you see the jobs numbers are strong. Consumers been very resilient. Inflation started to moderate, and the central bankers are talking about moderating policy. So there's a lot to be pleased with in the economy at the beginning of for the first 6 months of this year compared to what we might have thought.
And are you just referring to the US economy?
The US has been the strongest. The US has been the strongest. You look at China, for example. They took a while to reopen their economy after the effects of the pandemic. It's been a slow process for them to recover out of that. And then if you look, at other parts of the world, perhaps Europe isn't as strong as what we've seen in the US. But the US is the biggest economy in the world, and probably matters the most for the sorts of companies we invest in.
Yeah, absolutely. Okay. Fantastic. So let's come back and dig into artificial intelligence, or AI, a little bit more.
Yeah.
It's obviously really topical at the moment. In all the headlines every day this year, it's been a big driver of a lot of the market gains, and obviously it is a big theme in our portfolio as well, and a big reason our portfolio is up around 37% year to date. So going back, I think almost 2 years now, the team wrote a white paper on AI and cloud computing. It can be found on our website. So I guess what are your conclusions there?
Yeah, well, the big insight that we had coming out of writing that paper and the research that went into that is that cloud computing is going to be a multi-trillion-dollar market. And actually, it's going to be worth trillions of dollars more than what people were expecting at the time. And that's because AI is supercharging the demand for cloud computing. And it's doing that. We discovered that it would do that in 3 ways. So the first way is really the proliferation of new applications that are going to have artificial intelligence embedded in them. And there's a Gartner estimate that says that by 2025, for the 5-year period, there'll be 500 million new applications developed. Most of them are going to have AI sitting in them. The second reason was that there's a lot more data being captured, and so there's probably going to be 10 times the amount of data captured over the next decade than occurred previous to that, and that's going to be used to fuel these machine learning models to train them. And then thirdly, the compute intensity required for artificial intelligence and machine learning models is increasing at an exponential rate. So it's doubling every 3 to 4 months. It's the sort of thing just blowing, old Moore's law out of the water. Yeah. And so the combination of those 3 things just says that AI is going to drive much greater demand for compute, for storage, for networking, for all of the services that public cloud computing platforms provide. And that was the real aha moment for us, was that this cloud market, as a result of AI, is going to be worth not just $1 trillion, which is where most of the forecasts sat at the time, but many trillions of dollars.
Okay, great. So it sounds like a good opportunity for the portfolio. So what's the best way to invest in AI? Because it seems like there's a lot of user and consumer benefits like ChatGPT.
Yeah.
But where's the money actually made?
Yeah, well, look, I think our view is the same today as it was after writing that paper almost 2 years ago. The most certain winners in this space are the large hyperscaler companies, and that's Amazon, AWS, Microsoft Azure, and Google's cloud platform. They've already tied up the cloud computing industry. The 3 of those companies together spend over $140 billion a year on R&D. So they've got the cutting edge technology, and nobody can spend enough money to catch up with them now. But they've got more than that. Okay, so they've also got in certain of their businesses very strong network effects. They have data advantages because they see user data and they see data in many other of their adjacent businesses. They have really sticky relationships as well. So while they've got the best technology, they're actually also able to monetize it, and nobody else can come in and disrupt that cozy little oligopoly of 3 companies. I should probably say cozy big oligopoly of big companies. So those 3 to us are the most certain winners when it comes to AI and also cloud computing. Yeah. But there's going to be others. Yeah. And like, for example, we talked about Microsoft being able to embed AI features into their applications to make them better. Well, just overnight, one of our other portfolio holdings, Salesforce.com, who provide the sales automation software, they've announced that they're putting prices up, and this comes pretty soon after they were talking about artificial intelligence integrations into their software as well. So there's going to be other businesses that are able to do that, and we're following them and investing in them in some cases. But for the few winners that are going to come from this AI revolution, there's going to be a lot of losers too. There's going to be plenty of startups and plenty of companies with breakthrough technologies. But the question is always going to be, do they have the business model to monetize those technologies? And do they have the advantages to be able to sustain that over time? And that's what's not quite as clear to us at such a very, very early stage, especially compared to the confidence that we have in Amazon and Microsoft.
Yeah. Okay. Terrific. Did we have another couple of questions regarding this one as well? With all the hype, is there a risk of another .com bubble bursting in AI?
I don't think so. I think this is very, very different to the late 90s and the early 2000s. I think if you can compare the two, what you'll see is, firstly, the businesses that are leading in AI are well-established companies. They're massive companies, but they also have genuine profits and huge free cash flows. That was very different to what it was 20 odd years ago. And the valuations are very different as well. So the valuations are in the stratosphere back around the time of the .com bubble bursting. And we're at a very different point here. And I know people will point to high price to earnings or earnings multiples for the sorts of businesses that we just talked about. But they're making a lot of money. They're growing very quickly, and their valuation multiples still aren't anywhere near where they were for those tech companies that got caught up in the .com bust back in the early 2000s.
Yeah. Okay, terrific. So I guess while AI and tech is a really powerful theme for us, and obviously in the market at the moment as well, and we certainly are not just a tech fund. So let's switch gears and talk about some opportunities outside of AI and tech through the portfolio. So outside of cloud computing and AI, the biggest mega trend in our portfolio would be the alternative asset managers.
Yeah.
Our biggest holdings being Blackstone and KKR. Why do you like this space?
Well, it's a massive market and it's getting much, much bigger. So in its first 20 years, the alternative asset space, which includes the private markets that we talked about, private equity, private credit, went from almost nothing to $7 trillion. In the next 5 years, it's going to be $7 trillion bigger again. Okay. And this is an industry where the large players dominate. So amongst the top 5 players in the alternative asset space, they control 30% of the assets being managed. And then there's a host of thousands of others who fight for the rest. But I also like it because it's a sort of space where those big companies get bigger and the best get better. And it's because you take the example of a Blackstone or a KKR. They have a very long track record, up to 50 years, of producing stellar returns for their investors. That's a really powerful thing, right? That means that more people invest with them, more institutions have invested with them, and they've grown. And as they've grown, they've scaled out their platforms. They've employed the best talent in the market. That's enabled them to find the best deals, which drives better returns again. And you get this flywheel effect going on.
Yeah.
And so ultimately, they've been growing their share at the expense of much smaller players. So massive market, and it's growing quickly. And the big players that we've invested behind are actually gaining share in that marketplace.
So why do you think KKR is an exciting opportunity?
There's three big reasons why KKR in particular is exciting. We talked about the background of these firms being in or with traditional clients like the big institutions, and that was a big enough opportunity in itself. That's a $65 trillion market. KKR, along with Blackstone, by the way, has opened up the insurance market. So now they manage money for insurance companies who need to meet their policyholder liabilities. That's a $45 trillion market. So that's the first one. The second one is the massive opportunity in private wealth and retail. That's a $195 trillion market. And, there's a limited amount of shelf space there. When a retail investor goes to their bank or their broker, they're not going to stock every single one of those many, many thousands of alternative asset managers on the menu. There's only going to be a few, and they're going to pick the ones with the best returns, that are most trusted with the best brands, and that's that's going to be KKR as well as Blackstone.
Yeah.
And the third big opportunity for KKR is up in Asia. So KKR is the leading alternative asset manager in Asia, and that is a market which, well, as a region, Asia, including China, is accounting for more than half of economic growth in the world. And at the same time, allocations to alternative assets are about a quarter the size of what they are in North America and in Europe. So there's a massive market opportunity there that they're already leading. So I think those are three really big market opportunities for KKR in particular.
And what about the value equation?
Look, there's a really interesting part of the value equation with KKR.
Yeah.
So KKR actually invests some of their profits back into their own funds, and $25 billion of investments in their funds sit on their balance sheet today. If you were to remove that, what you would see is that the asset management business trades at about half the valuation multiple of all of the other alternative asset managers. And so straight away right there, we think that the stock's undervalued by half. And then as they grow their assets under management, as they capture the growth in the markets that we just talked about, we think there's opportunity for their earnings to go up 4 to 5 times over the next decade, and you get that on top of the valuation discount. So that's a really attractive setup for us.
Okay, yeah, brilliant. Sounds like a great opportunity as well. Okay, well, I think we might be nearly actually at the end. We could
You're going to cut me off.
But I'm going to have to stop you now, Chris.
Yeah.
So thank you for your time, Chris. Really appreciate it.
It's a pleasure. Thank you.
Yeah, thank you to everyone who joined in online and submitted any questions. Hopefully we were able to give you some good insights into the portfolio, what's driven the strong performance this year, and how the portfolio will make strong returns in the years to come. So there's certainly been a good rebound to start this year, and we certainly do feel there is further upside to come. I'm glad you also could hear Chris talk about the big opportunities ahead in cloud, AI, and the alternative asset managers as well. So any questions which were not addressed today, I will get back to you within the coming days. We will also distribute the recording of today's webinar for those who want to listen again or who just couldn't make it on live today. So we look forward to doing more of these, absolutely, in the future.
Yeah.
And I think it will really help bring you closer to the portfolio, Chris and the team. So yeah, in the meantime, thank you, and we look forward to seeing you all again, maybe before the end of the year. Okay, thank you.
Thanks.